Hello, members of the board, and welcome to our final analysis of Canada Helps' current financial position. Over the course of the presentation, we will be highlighting several important factors relevant to the overall fiscal health of our organization. These sections will include the purpose of our presentation, our financial ratio analysis, a summary of Canada Helps' financial health, a review of our service costs and budgeting, an analysis of the financial trends found in our work, and our recommendations moving forward. To provide a detailed and comprehensive look at Canada Helps' finances, we have chosen to focus mainly on ratio analysis. In choosing this method of calculations, we are looking to answer three main questions with our analysis. Is the organization accomplishing its mission? Is the organization financially stable? And are the results of operations acceptable? By concentrating on these three guiding questions, we hope to capture a comprehensive picture of the fiscal state of Canada Helps.
The long-term solvency ratios that we looked at were the debt ratio, the equity ratio, and the cash flow coverage ratio. The debt ratio shows us that they have a high debt ratio, so above 0.5, which is the recommendation from 2014 to 2018, though this is decreasing. The debt ratio is actually mostly made up of the trust assets and trust liabilities we found. And this is money that the organization Canada Helps is actually bringing in for other charities, and then we'll just be holding it and then pushing it back out to these charities. So it's not actually contributing to the long-term solvency of the organization, and it's actually distorting the debt ratio. So we subtracted this out of the debt ratio, and we found that they actually have a very healthy debt ratio. This tells us that their assets are not being financed using debt. We checked this with the equity ratio. They have an equity ratio of 1 from 2014 to 2018, which reinforces the idea that their assets are not being financed using debt. Then we took a look at the cash flow coverage ratio, which we see is above 1 from 2014 to 2018, which tells us that the cash from their operations have been covering their payments from 2014 to 2018. Which reinforces the idea that they actually are very solvent in the long term.
Next, we have the financial ratios referring to profitability. In assessing the fiscal state of Canada Helps, it is important to highlight the profit-generating activities we undertake. By looking at these profitability ratios, we can assess how Canada Helps generates profits, how well we are able to perform our mission, and how changes in our operations have impacted our revenue generation. Having analyzed the profits of Canada Helps, there are a few notable findings worth highlighting. Canada Helps has been fiscally steady for the past 4 years, never losing money for each dollar invested in operations or carrying a negative end-of-year balance. You can see here our total margin, or the total profit Canada Helps produces per dollar when considering all revenue and expenses, has been producing a steady average of 30%, or 30 cents of profit on each dollar of revenue yearly. This average has been affected in the last year by our change in accounting practices, which greatly inflates 2018's ratio to 197%. This chart reflects our operating margin, or profits per dollar generated by our operations. As you can see, in the last year, our operating margin has begun to expand after a 2-year slump in 2016 and 2017. Finally, the return on net assets ratio represents the rate of return on held assets, useful for determining if our assets are accruing at a rate faster than inflation. Canada Helps has made several sound investments in our assets, which yield an average yearly return of 30.7% of their base, far ahead of the 4.74% inflation rate over the past 3 years. This is especially notable, as Canada Helps does not rely on debt to fund its operations, so these returns are accessible for further investment or tackling ongoing debt.
In terms of the organization's liquidity, our team looked at the current ratio, quick ratio, and days of cash on hand. When looking at the current ratio, a solid current ratio is a 2-to-1 rate, and as you will see, Canada Helps is in a very good position to meet their current obligations as they come due. The recent spike in the current ratio is due to a reduction in deferred revenue from grants. This is a positive change for the organization as it means the organization is reducing the risk of needing to return funding to the granting organization at the end of the partnership, a position no nonprofit wants to be in. You will see a similar trend here for the quick ratio, where a 1-to-1 ratio indicates the organization is in a good cash position to meet our obligations through liquid resources. You will see that we have sufficient cash assets to cover those costs, again with a reduction in deferred revenue from grants. The days of cash on hand assesses if the organization can handle a collection crisis by measuring how many days worth of cash the organization has to cover operating expenses. This is a particularly important calculation in a time like the current COVID-19 pandemic and the subsequent financial recession, as organizations' operations and revenues are severely impacted. As you can see, the organization's days of cash on hand has changed drastically in recent years due to a change in the organization's accounting policies that recognize the payments due to its charitable partners as expenses. With that, it is important that Canada Helps Management in the future is aware of the cash available to the organization versus the revenue that is simply a flow through to the other organizations. Overall, while there is a liquidity risk identified by the auditors in the notes due to their long-term debts and lease agreements, Canada Helps is bringing in strong and diversified revenue through their transaction fees, corporate sponsorships, and grants to cover their ongoing costs.
Here we will look at common size financial ratios. We'll look at this from 3 different angles. First, revenue and expenses. Second, assets and liabilities. And third, proportion of net assets by type. Here we are looking at revenue and expenses as a portion of their total basis. Here we could just look at the actual revenue earned in 1 year for Canada Helps as well as the expenses, but what would come up is that the donations to other charities, reflected in the first lines of the revenue and expense categories, consumes 96% of the overall activity pie. And that's not very helpful if we're trying to look at what it really costs to operate for Canada Helps. So in the final 2 columns, we've actually removed the grants to other charities because we consider them externally restricted. What comes to light here is that 46% of their revenue is from other donations that support Canada Helps mission, and 16% of their revenue is earned on the transaction fees that they earn as a result of being a financial intermediary for the sector. On the expense side, after we remove donations to other charities, we can see that they pay a significant amount in bank charges and credit card fees, which is likely a result of their business model, and staffing costs account for about 45% of their expenses, which is quite normal for the charitable sector.
With regards to our service costs and budgeting, in the most recent year, we had some changes to how we handled service costs. These changes have shifted several of our calculations from their averages in 2018. This is likely because transaction fees are now counted as revenue, with the donations generated for other nonprofits, moving them from accessible to restricted revenue. With our financial analysis complete, there are a few trends in Canada Helps' finances worth bearing in mind moving forward. Thanks to our careful budgeting, our debt ratio has been decreasing year over year, and our yearly payments have been consistently covered by operating revenue, reducing the need to take on new debt. This decrease is aided by a recent increase in our operating margin, and the fact that we are regularly able to cover our costs with the cash we have on hand. However, Canada Helps has once again been flagged as a liquidity risk due to our long-term debt. Overall, the financial health of Canada Helps is quite favorable. Our debt ratio is below the standard 0.5. Our operating margin is on the rise, and we have a steady and favorable rate of return on our assets. The one major concern to our fiscal health that comes to mind is our lack of financial stability, as a result of relying on the highly liquid nature of our operations to cover our regular expenses. To conclude, we have a number of recommendations. As Canada Helps enters the next financial period, we have several recommendations for the board's consideration. The recent change in accounting practices has created an abnormality in our data, which may negatively impact how potential partners view our practices. Re-evaluating this change to return reported finances to the previous normal may be beneficial. We also recommend Canada Helps build a steady relationship with a single auditor so that our financial reports can be given with greater consistency. Currently, Canada Helps needs to keep enough funds on hand to honor every unredeemed gift card that has been issued. Amending our gift card policy would help free up some of the funds that are currently inaccessible. Finally, we recommend developing a mitigation strategy in the scenario that market fluctuation notably depreciates the value of our asset base. We thank you for your attention and look forward to working with you in the future.